It is Friday, April 10th, 2026, and the U.S. stock market just erased its recent wartime losses. The S&P 500 climbed 0.62% today, pulling the Dow and Nasdaq up with it in a massive relief rally. The primary catalyst is a formal ceasefire agreement between the U.S. and Iran. With the Strait of Hormuz officially reopened to commercial traffic, the extreme risk premiums priced into global markets over the past month collapsed entirely. This de-escalation triggered an aggressive wave of short covering across cyclical sectors like tech and industrials. Conversely, energy stocks pulled back sharply as crude oil shed its war premium. With the immediate threat of broader conflict neutralized, traders are rotating out of geopolitical panic mode and returning focus to baseline corporate earnings achievability. The bond market, however, enforces a stricter reality. The March jobs report came in hot, adding 178,000 jobs. The robust labor data forces the Federal Reserve to maintain a hawkish pause, eliminating a June rate cut. While the 10-year Treasury yield dropped to 4.33% on the ceasefire news, demand at this week's $39 billion note auction was notably weak, drawing a high yield of 4.28%. Tensions may have eased globally, but this friction in the bond market confirms that baseline corporate borrowing costs will stay elevated in the near term. This line chart tracks the S&P 500 against its 200-day moving average. After narrowly avoiding a full 10% correction, the index successfully reclaimed that critical 6,635 support level. Alongside that technical recovery, equity valuations cooled. Forward price-to-earnings multiples officially compressed from 21.7 down to 19.7. But the supply chain disruptions of the past few weeks leave behind an embedded inflation genesis. Current 12-month inflation expectations remain anchored high at 6.2%. You cannot simply buy the index blind here. The data dictates a phased entry approach, favoring only companies with high return on equity and the pricing power required to navigate those supply shocks. We saw this rotation play out clearly this week. Intel surged 33% after announcing an expanded domestic AI partnership with Google. In contrast, Tesla slipped 1% as falling oil prices raised concerns over a short-term deceleration in EV demand. This quantitative matrix tracks 20 target equities, factoring in a 25% margin of safety. Right now, exactly 8 of these specific names are actively trading at a discount. Even with broad market volatility, the numbers prove that highly actionable buying opportunities exist for strict value-driven capital deployment. For those managing engineering assets in Gabon, the immediate drop in oil prices takes a back seat to the capital expenditure cycle. Offshore infrastructure names like Tidewater remain deeply resilient value plays. Meanwhile, the stabilization of the 10-year yield at 4.33% provides a predictable window for structuring cross-border mortgages, locking in reliable parameters for your Singapore and Johor Bahru property acquisitions. Assess your operational footprint. With war premiums fading and borrowing costs leveled off, how are these immediate market shifts altering the timelines on the marine automation projects you manage?